in deciding what are relevant, first we get all the costs that we know are associated with that particular alternatives or products. So the first thing to do is now to begin to remove those things, elements that are not relevant in those basket of costs. So first we remove the sunk cost, then second we remove the common cost, okay, that do not differ between the alternatives, and that will leave us with what we call the relevant cost. Okay, adding and dropping a segment. One of the most important decisions managers make is whether to add or drop a business segment such as a product or a store. I'm sure we're all familiar with signs on the high street when we see closing down sales. These are as a result of decisions made by people like you when you are qualified as to whether we should drop that store, close it down, or drop a product. When you keep making loss on a particular department or store, you will at the point decide whether you should carry on with that store. So the decision here is a very typical example of decision management take. So let's see how we can use this in our decision making. Adding, dropping a segment. All right. There are two ways of doing this. The first one is to use the contribution approach, and then with their avoidable costs. Contribution approach will look at the lost revenue and the gain from avoiding the cost you should have incurred. That is the contribution approach. Remember now, we know what are avoidable costs, which are relevant costs. We now know the income that are relevant in taking a decision. All right. If you want to drop that decision or segment, you will be losing some income, no matter how small. But you will be gaining by not incurring those costs, which we call the avoidable cost. So this is the second way of making this completing the statement as to whether a decision, a project or store should be dropped or retained. The other alternative, which is above, is to compare the existing position without dropping the organization or segment or product, and then consider the unavoidable costs associated with that department or product. Unavoidable cost. Okay. So when you now look at this, that will tell you whether the current position with it or the unavoidable cost which you must incur. You see, you compare these two and see which one gives you the best result. That is how we will look at this decision making. So let's look at an example. There's an example here which I call one of four. There are 4 examples we need to go through here. Due to the declining popularity of digital watches, Lovell Company's digital watch line has not reported a profit for several years. A statement of profit or loss for last year is shown on the next screen. Before I carry on with this exercise or example, I want to know if we are good with the distinction between relevant cost and irrelevant cost. Anybody, any questions so far? Are you happy with identifying what are relevant and what are not relevant? Because this is the key to being able to carry out all this decision or perform the computations. I take it that we are all happy. So let's go into the computation proper. So at the next screen, we will see the statement on these digital watches. This is statement given for the digital watches. We have income, that is sales of 500,000. The variable expenses, variable manufacturing cost, variable shipping cost, commission are in order 120,000, 5,000, and 75,000. Total of these three items amount to 200,000, giving us a contribution of 300,000. Now, the fixed costs are deducted. The first one is general factory overhead of 60,000. Salary of the line manager for this particular segment is 90,000. Depreciation on equipment bought in use is 50,000. Direct advertising for these wristwatches is 100,000. Space, factory space rented is 70,000, and then the general admin expenses is 30,000. Altogether, fixed cost of 400,000, which is far more than the contribution. So they are making a loss of 100,000. Are you happy with the statement? Is the statement clear to you? Okay. All right. Let's move on. Further information is given as with regards to the fixed overheads there. The general factory overhead and the general administrative expenses will be allocated to other product line because they are not avoidable. So these costs are not avoidable. The two elements there. The equipment used to manufacture digital wristwatches has no resale value or alternative. This also is a sunk cost. Should Lovell retain or drop the digital wristwatch or watches? That's the question. Now, the decision rule. Lovell should drop the digital watch segment only if the fixed cost savings, all right, exceed loss contribution. Contribution approach. You get the loss in revenue because they're going to be losing. If they have to drop it, all right, they will lose the 300,000 contribution, which is sales less variable cost. But they will avoid some costs because they are not running or operating the department, the store. Because they are not operating the store, they will not incur the line manager's salary. That will be a savings. They will not advertise directly for digital watches. That will be a saving again of 100,000. They will not rent the factory. They will avoid that. Okay, that's 70,000. So the total cost they will avoid for not continuing with the digital wristwatches is 260. But compare this to the loss in revenue. They lost 300,000 and they gained only 260. So it is not worth to close the digital store because the loss in income exceeds the gain from avoidable cost. Is that clear? Anybody happy with this particular solution? Or do you need further explanation? Is that clear? Yes? Any other person? I said there are two ways to do it. the contribution approach, which we deal with the avoidable cost, or looking at the unavoidable costs that they will incur if they close them. So if you're happy, let's go for further explanation on this particular example. The comparative approach, which is the one comparing the existing position and the drop situation. If you look at the screen, can you see the screen again before I proceed? Yes, if you can see the statement again in 3 columns or 4, including the item column. Can you all see the statement on the screen? Somebody type yes. Thank you. Thank you. So you can see first column is the item, sales, less variable cost, manufacturing expenses, freight, commission, total variable expenses. The first column is the item column, explaining what the figures are. The second column is giving us keeping the digital watches. So that is their current position. The third column is now bringing out the unavoidable cost that they will incur if they drop the digital watches. Unavoidable cost. And the third column is the difference. If you cannot get it quickly from comparing the first to the second, the third will show you the exact bottom line. So we know the statement, the second column as given to us, contribution of 300 less cost of fixed overhead of 400, giving us a loss of 100,000. The third column is the unavoidable cost. If we stop the watch, what are the costs that we must still continue to pay? So they've told us that the general factory overhead will be paid. That 6,000 is unavoidable. Depreciation is unavoidable. It's a sunk cost, it's already incurred. General admin expenses, they told us again, will continue to be paid. So the total unavoidable cost is 140,000. So if we drop it, we will incur 140,000 loss. But if we don't drop it, we will incur only 100,000. So as you can see, it is not good to drop it from this second and third column. You can see the loss in dropping far outweigh the loss in not dropping. The differential will give us the exact amount of 40,000. So you extract the differential, 200 loss revenue, okay, and 500 loss revenue, 500 loss. Then all the costs associated is like benefit, so giving us a total loss of 300, because if you lose income, you gain from not spending those variable expenses. So the net loss is 300. Then the loss again, the gain is only 90 here, 100, 170, 260, giving us a total of 260 compared to 300 loss. So we are unable to cover the loss 300 loss because the gain is only 260. So that's the difference of 40,000 dropping up there again. Thank you. Thank you. Let's move on. The make or buy decision. When we are in the make or buy decision, what we need to do is just to ignore unavoidable costs in both decisions. Consider avoidable costs only. So, if we want to do check decide between make or buy, there are two different alternatives. So we go back to our fundamental principle, eliminate all the unavoidable costs or common costs, and we look into the avoidable costs only. That is very simple to do. So you check your costs to make it, you check your costs to buy. Any one that is unavoidable, we don't consider them in those two basket of costs. We only look at avoidable elements. Let's look at the example. A decision concerning whether an item should be produced internally or purchased from an outside supplier is called a make or buy decision. Okay, let's look at an example. To make or buy decision, example 2 of 4. Excess manufactures part 4A that is currently used in one of its products. The unit cost to make this part is, those are the unit costs. Alright, those both variable and fixed. So we have direct material 9, we have direct labor 5, we have variable overhead 1 pound, the depreciation of special equipment is 3 pound, supervisor salary is 2 pound, and factory overhead is 10 pound. This is 30 pound. Alrighty? To make it. You all can identify what is avoidable and what is not avoidable. The avoidable element here are those things that you can do without if you don't make this product. Can somebody tell me what if direct material is avoidable? I want you all to type in yes or no. Is it avoidable? Direct material? Type yes or no. I'm waiting for your answer. Is direct material avoidable? Yes or no? Thank you. Next person. I want at least 2 people to answer me. Thank you. Is it avoidable? Next person. Okay. Thanks. It's avoidable. If you don't do it, you don't buy the material. So also is direct labor. If you don't do it, you don't pay for that labor. So also is variable overhead. If you don't incur that. Depreciation will be there. Okay? Depreciation will be there because it will always be there. But supervisor salary will not be there if you don't do that. General factory overhead will be there. It's unavoidable. So the two unavoidable elements here are the depreciation and the general factory overhead. The rest are avoidable. So they gave us further information about this part before we can go to the composition proper. The special equipment used to manufacture part 4A has no resale value. General factory overhead is allocated on the basis of direct labor hour. The 30 pound total unit cost is based on 20,000 parts produced each year. An outside supplier has offered to provide the 20,000 parts at the cost of 25 pounds. So, we look at, for the outside supplier, that is the buy decision, we need to compare it with our make decision. So remember, we have to deal with avoidable costs in decision making. The avoidable cost on a buy decision is straightforward. The avoidable cost is £25. If we don't buy it, we don't pay the £25. Okay. On the make decision, we have actually gone through this line by line, and we eliminated 10 as unavoidable, reducing the cost to 20. We eliminated 3 as unavoidable, reducing the cost to 17. So our avoidable costs, relevant cost here is £17. So it will actually cost us £17 unavoidable cost, relevant cost, compared to £25 to buy. Will you buy it? If to make it is £17 relevant cost, and to buy it is £25 relevant cost. Which one is higher? Which one is more expensive? Looking at it from first principle. The two figures I've given you on the make and the buy, which one is more expensive? Can somebody type to me whether to make is more expensive or buy is more expensive? Type in the one that is more expensive. Bearing in mind that I've given you the relevant cost to make it, which is £17, and the relevant cost to buy it, which is £25. Is the make more expensive or the buy more expensive? Type it in for me, make or buy. Or put it the other way around. Which one is better? Should we make it? Is it cheaper to make it or cheaper to buy it? Let's answer it in this way. Which one should we do? Make it or buy it? Knowing that it will cost us 17 relevant cost to make and £25 to buy. Which one should we do? Make or buy? Type in your answer, please. I'm waiting. We are doing this together. It doesn't matter if you get it wrong. Okay. So, thank you for your questions. I want us to repeat the answer again the second time. Is it better to buy, knowing that buy is £25, or is it better to make, knowing that the relevant cost is £17? Which one? Make it or buy it? Relevant cost to make it is £17, and relevant cost to buy it is £25. Which one is better? Make it or buy it? Another chance to play your mind or adjust your position.
I think it's to buy.
To buy is £25 relevant cost. To make is £17 relevant cost. Which one will you do? £17 to make it or £25 to buy it? Which one will you do? No. Okay. So let me tell you that the answer is to make it. It's £17. Let's go back and revisit this structure. When we are making a make or buy decision, we look at the relevant cost. The avoidable cost only is what we are looking at. Relevant costing deal with avoidable cost only. That's the bottom line. The cost that will differ between two alternatives of avoidable costs. Avoidable cost, not unavoidable. Avoidable cost only. So we have actually listed the avoidable cost here when I was going through this question. 9 is avoidable, 5 is avoidable, 1 is avoidable, giving us 15 pounds. Then depreciation is not avoidable, we leave that out. Factory supervisor salary is avoidable. That's 2 plus the 15, 17 pounds. The rest are unavoidable. So we're looking at the avoidable costs, the relevant costs. All right. Those are the costs that we can avoid if we don't make that product. So those are the things we are looking at. So the avoidable cost here, the relevant cost to make it, because we will still incur the factory overhead anyway if we don't make it. We will still incur the depreciation expense if we don't make it. So those are not important to us, to the decision. It's like fixed cost. It will happen anyway, whether we make it or we don't make it. So they are not important in our decision. So we consider only the important elements, the relevant elements, the avoidable ones. So our avoidable relevant cost here is 17 pounds to make. Now let's go at the buy side. We have to pay them 25 pounds. That's what we agreed the price. And that's the relevant cost to us. 25 pounds to buy. So if I compare my 17 pound relevant cost to make to my 25 pounds relevant cost to buy, I will not buy. It's better to make it at the lower, cheapest and lower amount, 17 pounds. Okay? Is that clearer to everybody now? Yes or no? Thank you. So it's better to make it. So this is another way to find that out. To make it, it's going to cost us 340. Checking the relevant cost in total. I've done it in units, okay? I've done it in units. Cost per unit. Alright. So in total is 370. Alright. 370 and in total is 340. That is 17 pounds times 20,000 units. 17 pounds times 20,000 units, which is up here. That's what they want to make. 20,000 units times 17 pounds, that's 340. Alright? 20,000 pounds and 20,000 times 25 pounds is 500. It's 500. So it will cost you 500 pounds to buy it, as opposed to 340,000 pounds to make it in relevant cost 10. So the difference is 160. 160. Alright? That's the difference. Okay? So that's the way to look at this make or buy decision. So let's move on to other areas, for example, of relevant costing. So the next slide is simply explaining to us, okay, why the special equipment has no received value. All right. So it's a sunk cost. So ignore that. The general factory overhead is unavoidable. That's what it's telling us. So because they reallocated to other functions. So all right. So that's just the explanation of why those costs are unavoidable, and that's why we did not take them into account when we are checking our make decision. Opportunity cost. Are we at this slide? Opportunity cost. Thank you, everybody. So see you next time and remain safe. Bye for now.